Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And as you know, in my regular Wednesday episodes, I talk about the theories, methodologies, and principles associated with investing. The aim of these case study episodes is to share how it all works out in real life, to share some stories about some clients that I've been working with over a number of years. And in today's episode, I'm going to talk about a client that we started working with towards the end of 2016. So almost on 8 years ago now. And when we began working together, the clients were in their mid 40s, a family home, and a bunch of just other investments, a lot of actively managed funds, some in their personal name, some in a company because these clients were and still are self-employed. They also had some superannuation and some cash that wasn't invested. I would describe their approach to investment decisions as sort of very ad hoc, and really their portfolios when looking at it was, just a bit of a mess. And they used to sort of stress over their investment decisions as well. I mean, they had some experiences with financial advisors in the past, not so great experiences, I should say, which is not uncommon. You hear lots of sort of horror stories about dodgy financial advisors. I've got to say, just as a sidebar, a lot of that's due to conflicts of interest, and the government made a very, very smart decision years ago to ban commissions in financial advice, investment commissions, and I think that's gone a really long way to achieving much better outcomes. Today, advisors really have nothing to sell you other than their advice. So it's much like an accountant or lawyer where all you've got to do is just make an assessment of, does this person know what they're talking about? And then secondly, can I get along well with this person? Do I like and trust them? If you can tick both those boxes, then you're off to a really good start, I think. And the horror stories from the past, really just a result of people thinking they're getting advice, but really they've been selling a product. Anyway, I'm getting sidetracked, but I just wanted to sort of mention that because, it's a common story, but it's not a story necessarily repeating itself today. So they had some interest, obviously, their self-employed interest in the business as well. So a net investment assets when we began starting working together was $900,000. Now that ignores the family home and ignores any sort of business related sort of property or equity in goodwill and so forth, because I think that's just sort of separate. That's nothing that we've had any influence over. So the 900,000 was sort of spread across about 250,000 in managed investments and some direct shares. I had about 40 grand in a family trust, 260,000 in super, and that was a bit of a hodgepodge as well, and about 390 in cash. Now that asset base has grown to about 2.5, 2.6, $2.7 million, sort of circa that amount. So over the last sort of 8 years, it's been about a $1.7 million uplift, or 2.8 times their investment assets, which isn't a bad, 8 years, it's not even 8 years yet, but isn't really a long time in terms of investment, when it comes to investing, to enjoy compounding growth and so forth. So it's a pretty good outcome, I reckon, over the last almost 3 times their investment assets over the last 8 years. And so where is that sort of 1.7 come from? Well, we bought an investment property in 2017. Actually hasn't done that well. It's a great asset, great location, awesome asset, but it's in Melbourne. And I've spoken about that before. So we generate about 200,000 in equity there. There's a $600,000 uplift in super. So the super has grown from about 260 to 870. We've got a lot more investments. We put that cash to work. I said they had about 390 of cash when I met them, and we put that into a company and trust structure. So really that's a trust with a corporate beneficiary for those that, like to nerd out on these things. And so that their assets, those two entities' assets are north of 750,000 now, $750,000. They've got some more cash. They continue to accumulate cash to, offset debt partly, but also their kids are going to some or pursuing some quite expensive overseas tertiary education. So we need to sort of provide for that. So we've got quite a bit of cash, about $660,000, and we've made some commercial property investments which haven't yielded any return yet. That's just been a very recent thing. So you can see that really cash, a little bit of property, mostly shares and super have contributed to that uplift over the last 8 or so years. So what have we helped them with over the last 8 years? Well, as I said, we purchased an investment property back in 2017 for about $1.3 million. It's probably worth 155 to 16 today, looking at comparable sales. So it's okay, but it's not what we would normally expect on a long-term basis. But, my view with respect to Melbourne, particularly investment grade assets in Melbourne, over the next 10 years, I would expect a very high probability that that asset is going to be worth substantially more than what it is today. We cleaned up their direct share and managed funds portfolio, and really then allocated investments into the correct ownership structure. So again, using the family trust with a corporate beneficiary. The corporate beneficiary means the family trust can distribute to that company, and depending on the nature of that income and the distributions, it's only going to be taxed at 25%. So instead of, distributing those monies to the individuals, they're on the highest marginal tax rate, they're going to pay a lot of tax. So that sort of investment structure works nicely. And with respect to our approach with sort of cleaning up poor investments, we don't necessarily, in fact, we almost never, well, actually, we can say I've never taken the approach where I've met a client, you've got a whole bunch of investments, let's just sell the lot and reinvest somewhere else. Typically, what we do is sell down over time. We want to be strategic about it. We don't want to just give them away. We want to maximize the exit proceeds. And so quite often it can take many years to really divest of what we might feel is a poorly invested portfolio and then get something closer. I mean, they're pretty close now, but for example, I was looking at a client recently and they've got some emerging market investments that are expensive and actively managed, probably won't outperform in the long run, but there's no point selling emerging markets today. They're really undervalued. So why not just keep that investment, wait for the turnaround. When the market turns around, then we'll take that profit off the table. So kind of that's been our approach over the years to try and, start moving a portfolio to something that's going to perform better. And the same with super. So the $260,000 of super that the clients had when we met them, half was invested in direct shares, the other half was just in cash. So we've obviously put that to good work, and also they've been making additional contributions over the last number of years as well. And then we've had to advise on a number of other things over the years: asset protection, as I said, funding overseas, tertiary education, looking after their parents' monies, all those sorts of things. There's one thing that doesn't change in life, it's changing circumstances, changing markets, changing conditions, changing cash flows. So to navigate all that sort of stuff is really important. So as I like to do, as you know, I like to reflect then on the case study. Okay, so that's the road we've traveled, they're the outcomes, that's how we've invested. What have we learnt from that journey, either positive or negative? Look, the first one is, and I don't like to put a huge weight on this, although, I spoke about it last week as well, but the clients, when we first met them, they felt making investment decisions was really taxing and really stressful. They already had a lot of stress in their day-to-day. They had, when I met them, young kids, and, obviously that takes a lot of time and their own business. And of course, there's stresses associated with that, but you don't need to be self-employed to enjoy those stresses. They can be present in sort of any occupation, really. And, they felt there was a real weight lifted off their shoulders, knowing that they didn't have to make those decisions anymore, that they could kind of outsource the decision making. And I think that's probably, looking back, not only are the results been good, so, at least they can sit back and go, well, that was a good decision because it's worked out well for us, even only 8 years later. But I would think they would reflect, I know from our discussions, they reflect and go, well, that's just a huge weight lifted off our shoulders because we didn't really enjoy making those investment decisions. And as I've spoken about before, in fact, spoke about last week, some people are going to be natural with it, investing money. They really enjoy it. They like it. They've got a natural flair for it. They spend a lot of time researching it because it's a natural interest for them. That's fine. For those people, it's not necessarily such a burden to make those decisions. But for people that aren't built like that, it can be really problematic for them and cause a lot of stress. Whereas they can now focus on their day-to-day, the stuff that they enjoy and so forth, and kind of leave the investment decision making to me. So that's probably the biggest learning out of it. Now for me, someone that does, enjoy it and have a lot of experience with it, I don't necessarily, for me, I can't identify with that, but it's sort of just interesting outcome, I guess, of working with these clients to appreciate how much of a benefit that can be to some people. The second observation has been tax, tax considerations, particularly with structuring of investments, and then also minimizing capital gains tax. This client's been selling down some shares in the business, and so there's been some capital gains tax there. Making sure we've got the right asset allocation across the portfolio. So, we've got gearing in personal names. We've got some assets outside super, as I said, using a family trust and then a corporate beneficiary to minimize the income and any capital gains that come off those investments. But then also trying to get as much into super as possible, and we'll eventually move whatever money's, maybe not in the company because they just can sit by themselves, but the money's in the trust will eventually, as they get closer to 60, move them inside super as well. And then using those super contributions to minimize capital gains tax liabilities. As I reflect back, there's been quite a bit of tax considerations and structuring within their portfolio. I think that's helped obviously maximize after-tax returns over the last 8 years as well. And my other observation, which again, a bit of a common observation, but we've employed a bit of gearing in their strategy. So as I said, in 2017, we borrowed to go out and invest in property. And whilst we've enjoyed, an uplift in value in that property, we probably, if you looked at sort of straight line returns, probably should have expected to be in a better position than what we are today, equity wise. Now, that's not asset specific. There's nothing wrong with the asset. In fact, it's a fantastic investment grade asset. That's really just related to, the market conditions, the geographical market that we've invested in, i.e. Melbourne. But it's not that big a deal, right? Because their other investments are off to a good start. We've built a portfolio of, a reasonable portfolio of assets outside super. We've got $755,000 outside super. We've got $660,000 inside super. So that's off to a good start. Our problem will be, or our challenge will be, how long will that money last for? Well, they're going to work for probably they're in their early 50s now. They're going to work for another, let's call it 7 years. So those assets will compound and accumulate. So what have they got? They've got sort of nearly 1.5-ish, getting close to that. So then maybe that's going to be $2 or $3 million by the time they get to retirement age, which is great. The investment property role, the gearing role in their strategy will be to underpin those assets. If we start retirement at say 2.5 of assets and we spend a lot more than what we expect, maybe 15 years after retirement, when they're in their mid 70s, they might think, oh, look, we're really eating into this capital, we're going to run out of money. That's when the property's going to kick in, right? So not for another 20 years. We can leave that strategy to start paying dividends over the, and hold it for 20 to 30 years, that asset, and it will definitely pay dividends. So the fact that we haven't enjoyed the returns doesn't really worry me because the asset is really good quality. And I know from a strategy perspective, we're not reliant on it to pay dividends in the early part of their strategy. It's really about, making sure that asset's going to work and accumulate significant equity 20 years from now, really. And the clients understand that too. So it gives them that comfort that, they're not solely dependent on the share market either, because if the share market blows up or the share market returns are pretty ordinary for a period of time, at least they've got exposure to alternate asset classes like direct residential property. So there you go. This one's a bit of a different one because we sort of started with a mixture of assets, and that's been the strategy to try and over time strategically divest of some of those assets, reinvest, invest new cash flow, and try and rebuild the asset base. So I think we've been pretty successful in doing that, but also laying some groundwork, as I said, for longer term positive outcomes as well. Okay, let's get into some listener questions. The first question I want to talk about, or answer today, I should say, is from Arwell. He says, I love your podcast. It's so informative. Thanks, Arwell. That's really nice. The question I have is about investing a large sum, circa $200,000, into one ETF. Is it better to invest the whole lump sum in one go or split it and invest it over time? For example, 10 lots of $20,000. It's a really good question, Arwell. And if you have a look at the evidence actually says invest it in one hit. And the evidence will tell you, whilst you might not be better off doing that in 5 to 10 years' time, if you have a look over a multi-decade period, say 20 years from now, you would have been better off doing that. And the reason for that is that you never know when the returns are going to come. And most of the returns will come within 20 trading days of a year. So out of the year, there's going to be 20 days that are going to deliver sort of 3%, or 2% uplifts in terms of returns. They're the good days, right? You don't know when those good days are going to happen. So you've got to remain fully invested. And that's kind of the thesis around, investing in one lump sum and so forth. But look, I don't subscribe subscribe to it. Whilst I acknowledge that's the evidence, to me it just doesn't feel right. It doesn't make a lot of sense, because what that does, or that approach does, is sort of say, well, I'm all about returns and not about capital preservation, whereas I think not losing money is arguably just as important as making money. So my approach for you, if I was investing $200,000, I would actually invest it over a much longer period of time, particularly where markets are priced at the moment. Now, if markets were cheap, if we had just been through a 30% correction or something, yeah, I would go gangbusters. I'd probably invest it really quickly. But I think because markets are relatively expensive, or at least fairly valued at the moment, there's not a lot of markets that look like they're cheap, except for emerging markets, but you're not going to put a lot of money in them. I would invest probably $8,500 per month over the next 2 years. So that is, invest that $200,000 equally over the next sort of 2 years, because it spreads your timing risk. But if the market was to crash, so if I saw a 10% or more fall, I would start investing more money more often. And whilst that might seem like a really good idea today, you have to realize it's not going to seem like a really good idea when it actually happens. And you have to really make friends with that. So quite often there's these surveys of people to try and measure risk appetite, right? And the survey is like, well, how would you feel after a 20% drop in the share market? And most people in the cold light of day with complete rationalism go, well, it is what it is. Markets behave like that. We know, we'll just stick with it for long term. I'm not too worried about it. However, we should really provide some context around these questions, because it's what caused the market to drop 20% is probably what you're going to be really worried about. And because of those things like COVID or a global lockdown, or if we go back to the GFC, the financial banking system just blowing up, that's the backdrop of what caused the large crash. And with that backdrop and a lot of negative news, probably no positive news in those situations, you're not going to feel confident to go and turn around and put another $50,000 in the market. However, that's exactly what you should be doing. So if the market was to crash, for example, 20 or 30%, I'd probably take the full, it would probably make sense to take the full 200 almost and dump it in the market. Now, I wouldn't do that. I'd put in 50 and then maybe another 50 a few weeks later, whatever it looks like, because you never know when the bottom is. But that's why I would take the approach to invest relatively conservatively, at least initially. Then if there was a market correction, I would be more aggressive in terms of how I'm going to invest. And I can take that approach as a financial advisor because I'm completely unemotional about the approach we're going to take with client monies. Although I must say, you're not completely emotionless. We did a lot of investing in March, April in 2020, when you remember when COVID hit and the market really crashed. I can't say absolutely, I was completely confident at that time. I knew theoretically, we absolutely should be investing. And in hindsight, it was a fantastic decision and it was the correct decision. But I won't say that I was full of confidence at that particular time. So, but you have less emotional impact when it's not that it's not your own money, but when that's your job, is to be unemotional about it. I think I've prattled on too much to answer this question, but I just wanted to provide some context around, the sort of things that we think about, I think about when investing in share markets. Okay, the next question, change speeds here, is from Andrew. It's really about borrowing. Andrew writes, I have a question about borrowing money for property investing with a focus on different challenges for new business owners compared to permanent employees. I'm close to starting my own business and have half planned an exit from my engineering role. In short, I would only resign from my engineering role if I could replace my salary, or at least 80% of it, to protect current debts. So the core question is, have you had clients make that jump to become self-employed without interrupting their investment goals or strategies? How do lenders treat self-employed people differently? And does it depend on the salary you pay yourself, or can the business leverage itself to increase its borrowing power? At the end of the day, I want to maximize my salary to continue investing in property. So self-employment is my way of increasing my borrowing capacity. Since investing is the top priority, I'd sooner close the business and return to an office role if the business wasn't performing as expected after a few years. Okay, so that's a really good question, Andrew, and it's a really common scenario, I guess, of people sort of trying to work out what impact that will have. And a lot of people, certainly in my experience, will either go and do contracting or become self-employed. And the aim there, sometimes it's flexibility, but also to try and maximize their income. And maximize your income will do two things. It's going to maximize maximize your borrowing capacity eventually, and it will also maximize the amount you have to invest. So I would tick it off to say, yeah, in isolation, from a financial planning perspective, it's a good idea. Let's go and do that. Now, does it interrupt the investment strategy? Yeah, it can. It can delay a client from investing for maybe 1 to 2 years. I'll get into that in a second. But in the long run, and remember, we have to make good long-term financial decisions. In the long run, you can more than make up for that small delay of 1 or 2 years through, high earnings and higher amount that you can invest in. For a lender, if you've got a business, a lender could consider lending to you after you have one full financial year of history. So that's, the full financial year. Some lenders will just go off 1 year's worth of financials, for example. Most lenders will look at 2 years and average it out. It's going to depend on the type of industry you're in and the type of business you're in as well. If you're opening up a group of sandwich shops, there's a lot of capital investment involved in something like that, and they can be a little bit more volatile. A bank's more likely to look for more consistent income. If you've got an engineering consulting business and you've got a couple of really key clients, maybe some of the income is contracted for a period of time, well, that's a lower risk business, and you can sort of have a conversation with the bank, but you're going to need typically at least 1 full year's worth of history there. And so if you can manipulate to make that change sort of just towards the end of a financial year, so your 1 year's worth of financial year history is going to be a full financial year, that would actually be beneficial if you can manipulate it that way. Lenders don't really care about the salary you pay yourself, so they will add those things back, your superannuation contributions, your salary, because sometimes that's a question we get is, should I pay myself a higher salary from my business, and will that increase my borrowing capacity? At the end of the day, the lender's going to add those things back. They're going to look at your business and work out how much discretionary profit do you have. And that discretionary profit, because it's at your complete discretion, could be used to pay a salary, could be used to pay super contributions, could be used to not pay, it could be used to pay dividends, could be used to retain in the business. It's your complete discretion, right? So the bank's going to look at, okay, what's the business's income? What's the business's genuine expenses? And therefore that gives rise to, what discretionary profit you have. And then that's really going to determine what your borrowing capacity is. Now, if you do want to get yourself into a position to be able to borrow as soon as possible after you become self-employed, it is important that you work with an accountant that understands mortgages and finance and lending. Look, I was having a chat to one of our accountants the other day, and he was making a comment to say in the financials, there was something called amortization. Amortization's like depreciation. When you get an asset and you depreciate it, which means that what you're doing is saying, well, the asset isn't worth what it was worth at the beginning of the year, either through wear and tear or usage, or getting close to the end of its useful life. So we claim some depreciation. Amortization's normally for intangible assets like goodwill or something. So if you go and buy a business, you want to write off goodwill, typically that's amortization. Either way, they're kind of the same thing, right? They're just a book entry that reduces the profit, reduces the business taxable income, but it's not a cash flow item, right? So from a borrowing capacity perspective, a bank will normally add back depreciation, add back amortization. Now, in this situation, because in the accounts, depreciation was actually called amortization, the bank didn't know what was going on. They wouldn't add it back. They would refuse to add it back. So, making sure that you work with an accountant that's going to, make sure they maximize the income that's recorded in the accounts in that financial year. They minimize as much as possible the expenses, and then they structure the P&L, the profit and loss statement, so that it's going to be easy to understand for a lender to then work out what is the discretionary cash flow net of all business expenses coming off this business, and what can I rely on in the future. And so working with a good mortgage broker that then collaborates with a good accountant will help minimize any of those possible issues and maximize your borrowing capacity in the long run. So Andrew, a great question. The short answer is yeah, it could interrupt your investment journey a little bit, but that's really just a bit of short-term pain for long-term gain. In the long run, if you can earn a higher income, then you're probably going to pay less tax as well, because you can obviously hopefully minimize your taxes as a self-employed person and not pay any more than 30%. And then that will obviously improve your after-tax dollars and have a massive positive compounding impact on your personal financial position as well. So hopefully that sort of answers your question, and I'll say good luck with your business. Okay, one final question before I let you go, and this question is from Stephen. And Stephen writes, noting the recent boom in Perth, Brisbane, Adelaide housing, what should existing investors think about if they're planning to take profits and reduce their exposure to each market, assuming the properties are not sort of blue chip investment grade assets? Good question, Stephen. That saying, no one rings a bell at the bottom or the top of the market. It's difficult to really work out. When we look at those markets, Perth, Brisbane, Adelaide, they're certainly boomed. We can tick that box. Has it got to the peak of the market? Because in a rising tide, all ships rise, which tends to mean that even poor quality assets tend to appreciate in value as well. So if you realize you've got a poor quality asset, whilst you might conclude that in the long run the returns are going to be suboptimal, in the shorter term, because of you're in a rising market, the returns could still be good. And the last thing you want to do is go and sell a property for 600 grand today and then read in the paper 5 years time it's resold for 850, 900, something like that. You'll kick yourself for kind of missing out on that uplift. When I look at those markets, I would say, look, Adelaide's probably getting close to fair value. I wouldn't say it's overvalued. I think Brisbane might have a little bit more steam left in it over the next couple of years. So I'm not really worried that market gets so sort of overcooked. You get worried about prices where, Hobart a couple of years ago, and it has lost a bit of steam since, looked a bit silly, and particularly in light of sort of longer term trends. I don't think I'd put Brisbane and Adelaide in that basket just yet. And Perth, whilst it's boomed, I've heard a few people say over the last few months, gee, we've missed the boat on Perth. I don't know about that. I think Perth's had 15 years of virtually no growth, and probably in real terms, if you factor in inflation, depreciating prices over 15 years. And we've only had a couple of years of, albeit a very strong market, I acknowledge that, but only 2 years. 2 years doesn't make up for 15 years of lost growth. So I think that market's still got plenty of legs in it. If you forced me to make that sort of forecast, which I acknowledge you didn't, I just did that off my own accord. So what do you need to consider if you've got a property in those markets? Well, episode 316, it's called 6 Important Considerations When Selling a Property. I guess I probably published that episode since you submitted the question, so maybe that'll go a long way to answering it. I think some of the more specific questions, if we're thinking about those markets, I'd be thinking about capital gains tax. So that is, right, how close are you to retirement? Because I don't think any of those markets are going to blow up necessarily soon. And so if you're going to retire in the next, say, 1 to 5 years, you might consider not selling now and selling when you're in retirement. Hopefully then your taxable income's lower. So I don't know what your taxable income is today, is lower, and therefore help you minimize capital gains tax. I'd also wonder, or ask the question, how bad is the property? Is it a real pain in the ass in terms of a poor tenant or requiring a lot of maintenance and costing a lot of money, those sorts of things? Or is it just suboptimal in that, it's okay but not perfect? Because if it's okay and not perfect, I'd probably ride it out a little bit longer. If it's a real pain in the neck, I can understand you might just want to take your money and run. And then also the other thing is, what are you going to do with the capital? Do you have something compelling to do with it? So for example, if you said, look, I'm going to sell the property, crystallize equity and repay my home loan, have no non-tax deductible debt, I think that's pretty compelling, right? Because it's going to save you 6-ish% on an after-tax basis. You've got to earn sort of 9-10% to achieve that. So that's a pretty good return on your investment. However, if you didn't have any other sort of compelling opportunities to reinvest those monies, then again, I'd be more leaning towards, sort of wanting to ride it out and see what happens. Look, typically what property markets do is that they'll have a boom and then they'll just go sideways. In fact, they might have a boom and they might come back 1 or 2% and then go sideways, right? So unlike the share market, where if you wait too long, you could miss out on a lot of the returns, it's less likely in a property market. There are times where a market starts to look really overcooked. Like I said, Hobart a few years ago started to look a little bit like that. Again, I don't think Perth, Brisbane or Adelaide are at that levels. Adelaide's getting close, I should say. So if they do then start looking overcooked, then you've got to take your money and run. But waiting a little bit longer for property markets, not always, but often doesn't come with a lot of downside risk. I hope that answers your question, Stephen. Just a reminder, I've got a 97-point checklist that you can download for free. It gives you 97 points to ask yourself around investing in property, retirement strategy, super, all those sorts of things. Feel free to download that if that's of interest. And until tomorrow, bye for now.